All right, welcome everybody. I should be unmuted now. If somebody could just let me know if the mic sounds okay. I think it should be okay, but sometimes I have it on the wrong setting, so I always ask for a little bit of confirmation. Bueno, perfect, good, cool. All right, so I just thought it would be good considering we had an extra day off. Obviously today, U.S. markets are closed. European markets were open today. They had another, I would say, crappy day in Europe, and and still China is closed. I think it was a Chinese New Year, and then not only is China closed, but a bunch of other markets are closed. So you can see how the VIX closed today. Kind of what we saw a couple days last week. So I'm just waiting for that to come up here in Bloomberg. I think I've got a lot of recording on two different systems, so my computer might be a little bit slow. But you could see Euro stocks finished down 0.5%, and the other thing that was weird about this is Japan had a really nice night. So last night, while China is closed, there were some markets that did pretty well, including the Nikkei, and it just seems like right now Europe is lagging a bit. So not really sure what the reasoning is for that right now. You could see on Bloomberg, I actually put together. I did have a chart someplace on it. What did I do with it? Maybe it's over here. Um, here we go. Yeah, so you could see that over this is the last 10 days, and you could see that there is a definite weakness going on in Europe. The orange line is, over the last 10 days, the orange line is the S&P, and the white line is Euro stocks. And you could see for a while, and why I think it's kind of interesting is because I think over the last year, there's been decent tracking between European stocks and U.S. But you could see over the last 5 days, the S&P and U.S. stocks really outperformed a bit, but Europe has been lagging. And you can see it closed on its lows here. It finished okay here. I think this was Friday. Friday had a decent close, and of course, we were plagued by a little bit of political headlines, but and then you could see today just closed on its lows. So it's a little bit different market environment than what we saw for the most of 2017. 2017 was really odd. Most markets globally rallied. Of course, there was different degrees of that, but it could be that some of these regions are starting to separate a little bit, such as Europe. So we'll just have to kind of keep an eye on that. What I wanted to go over tonight is just to kind of take a step back, because I know during the day in the trading room, spend a lot of time watching flow and really getting a nice pulse for what the risk appetite is amongst the institutional players. Also reading ETF big blocks as well, which really came to really, I found a couple good signals in that going in the back at the beginning of the week. There was a lot of money that was put to work in emerging markets. So, that's where I kind of spend the day. But, I do like to throw in the midday session as much as I can, strategy and just, my overall thoughts for the market. But I always get distracted. It seems like, especially right when I get into like deep thought about something, there's a big order that comes up, and it's like, whoa, look at this. This could be an interesting trade to take. So it's good to kind of do this, and I encourage you guys to make the most of your membership, and by all means, either send me a private message in Slack or send me an email if there's a topic that you want me to go over, if there's something that you're not understanding that we go over very quickly in the trading room. So now is, it's an excellent time to do that. And so anyway, I want to get back into, I think kind of got sidetracked. I got sidetracked a little bit with a couple weeks of vacation. I like to ski in the wintertime, and then also with the market volatility, just got a little bit distracted as well. Obviously managing positions and making a lot of decisions quickly. So not quickly, but having to do that as stops were hit and so forth. But so I wanted to go over, because I really think the financial media it tries to really do a good job at creating a lot of uncertainty and a lot of indecision. It makes you really worry about things that you probably shouldn't be that overly worried about. If things are going to happen like a correction, or if we're going to move a little bit lower, it's going to happen. There's tons of people who, analysts or financial writers that come on and basically have a viewpoint and try to predict the markets. And that's fine. They can do that, but they should also at the same time, I feel like, put like their track record of making these types of predictions, if that's what they're in the business of doing, because most of them are straight wrong, or at least their timing is way off. But sometimes the more that you have the TV on, or the more that you're reading Twitter. I mean, Twitter is great. You can get a lot of information from Twitter, but it could really hinder your decision process, because you're like, oh, geez, I didn't think of that. That's another thing to worry about. So, I'm going to talk a little bit about that with the technicals and where we are. But let me go through first what we do know. And I think there's some good takeaways from what we do know, rather than trying to predict the next move up or the next move down, or what have you. But there are some things that we do know that can kind of help you in your trading and your process and your plan itself. So the VIX is a 1946. I think actually VIX futures are back over 20 right now. So that's a lot higher than we were a month ago. Just a month ago, it was 1127. I mean, we went all the way up to, what did we touch? 50 or close to 50 just for a little bit. So what that tells you is that there's a higher level of volatility. You go into what the VIX measures, and it says it right there, black and white. It's not, some people I think get this confused a little bit, but it measures. If I can get this thing up, but yeah, I mean, it measures the not implied correlation. I guess this doesn't want to come up, but basically what it does is it measures short-term volatility, and it looks at just a few contracts just a couple months out. It's a short-term gauge of volatility. So as that starts to move up, it just means the market is pricing in more volatility with a higher read. So the higher you go, just the more that the market is looking for that. And what I've been trying to why I've been watching it so closely is I want to see when that starts to dissipate. Of course it always means that percentage, or that reading of 19 means that it could go higher or lower, right, in volatility. But usually the volatility is associated with a down move. That's typically how it happens. When markets are pretty calm, they can grind higher. When markets start to get more erratic, that usually means, especially, it's the old saying, stairs or escalator up and the elevator down. So right now, I would say, and just because if we do return back to a 12 or 13, then there's other things to worry about. Is the market pricing in too little volatility? But right now, you can make the conclusion that the market is pricing in or looking for higher volatility than it did a month ago. So that should tell you a little bit about how you're trading options, and about the amount of risk that you're taking too. Your positions will move a little bit more. You could also do a little bit different strategy with this. You could look at, just as I've been doing, and I wanted to talk a little bit about this as well, I started to day trade a lot more. There's a lot more opportunities when the VIX is higher, when things are moving more, even to trade index options. I have up over here, so I'm going to kind of hit one of these one by one, but I'm just going to kind of talk through these bullets. But I did want to talk a little bit about the JCJ index. This is implied correlations. This generally it's a measure of how the S&P, the components of the S&P 500, how they move together, whether or not they're moving in a group, or whether or not they're kind of doing their own thing. For the last couple of years, we've seen implied correlations move down. Stocks, it's been a stock, and what that means is it's a stock picker's market. And I've advocated, in my own trading, I have not day traded as much. I've done more swing trading, and I've done very little index trading. Futures trading I really don't do anymore. Which is a whole nother subject, but or just trading SPY or Qs or IWM. I really haven't done that the last couple of years because that's not where the opportunities are. When implied correlations are really low, it is what it is. It's a stock picker's market. There's a lot more opportunities in single stocks. So I've done a past webinar about that, but it's just math, and it's just these are true measures. They're not really a buy signal or a sell signal. It's just telling you whether stocks are moving together. What we've seen that's a little bit different this year, and with the spike up in volatility, what tends to happen is with a spike up in volatility is a lot of stocks start moving together. So it doesn't really, there's still going to be some degrees of separation, but it's not like it was a couple months ago. Why? Because that implied volatility, things will start to move more and more together. So you will see me, and what I did last week a lot more is trade the Qs or trade SPY, maybe IWM. Those things, as they're moving more, it becomes more of an index market. And it's funny, some people just don't look at that. Some people have it ingrained that they're only going to do one type of trading. The beauty of what you're doing as a retail investor, you're not a fund. You don't have to stick to your bylaws and your prospectus and say, hey, I'm only going to trade this type of this strategy. You could do whatever you want. So you could trade what the market is giving you. So I mean, that's basically what I did last week. I just started day trading a lot more versus swing trading, because when you do have that volatility, it tells you that there's a decent amount of volatility on a day-to-day. The market is moving faster than it was. And also, the uncertainty is a little bit higher than it normally has been, or what it was in 2017. So, you might be a little bit more uncomfortable about holding positions. If you were holding positions for 3 to 5 days, there's a little bit more uncertainty around it with a higher VIX, right? So that's just how it is. That's what we know, and I'm not making any prediction about it. That's basically just the laws of those, of what the market is. Any questions so far? That's a mouthful on the first bullet, and I think I also covered bullet number 3: implied correlations rise when volatility rises, stocks move together. But that's again, it's being able to recognize that, and if you are not just pegged as a swing trader or a day trader, there's a lot of different things that you can be doing as long as you're flexible. All right, I don't see any questions. All right, so far quiet crowd. So I'll keep going through this, and then as I start going through charts, and if you guys want to look at some stocks, we can certainly do that. What I also, this is really not outside of what the market is currently doing, but March is now front month, right? We're past February we're past February option expiration, and now we're on to a new month. So I always like to touch upon that once we're in a new month. I think it's very important to look at all your positions, what expired on Friday. How many positions did you have that expired worthless? Yeah, I mean, that's all your own strategy, really. I mean, that's something that you have to. I can't really tell you that. I'll answer that question in 1 second, Bob. But so I think always what a good exercise to do after monthly expiration is to go through in your account and see how many positions that you had that expired worthless. If generally, I think if you had 1 to 2. You probably took a little bit of a loss, or maybe that was a strategic position. Maybe you were okay with that. Maybe it wasn't a swing trade, but maybe a day trade that didn't work well. And I think that's you traded okay. Once you get up to the area where you have like 5 positions that expired worthless, you're basically doing something wrong. Because I mean, again, unless you're kind of just taking a lot of lottos and you didn't have a lot of money and really invested in those. But what I'm talking about is if you had a lot of swing trades that expired worthless, you really, I would say, did not do a great job at managing your positions. It really, by the time that you get to the point where your positions are getting close to expiration, and you're kind of hoping that maybe they might come back at the last minute, it becomes very hard for some of those positions that are marked around like 10 cents or below to really come back. So now that March is the front month, really what you want to be doing now is looking at your portfolio and saying, hey, how many positions do I currently have that are expiring in March, right? We know that front month positions, the theta decay is the highest. And you could just Google, I'm not going to do it right now, but you could just Google yourself, go through and just look at theta decay, look for a picture of theta decay. And you'll see that once you're in front month, the theta decay, it's kind of like the analogy that I use is you're swimming basically against the tide once you're front month. Again, if you're just day trading, it's fine. But if you're swing trading and you're using March, you have a little bit of a death wish, right? Because you know the longer that you hold that position, the more time decay is really hitting you hard. And especially, let's say if the stock doesn't do anything. Let's say that you bought $2 out of the money calls or puts. Doesn't matter, and the stock doesn't move. That meter is running, and the tide is getting stronger and stronger against you. So there is an advantage to trading front month. They're cheaper options, but there's a reason why they're cheaper. So I wanted to put that in perspective for you, that there's only 19 days in March. So right now, I think is an excellent time. I think I have one position. I think it's Taiwan Semiconductor that expires in March. And that position, I've already taken it hasn't been a huge winner, but I've taken a couple targets in it. And at least it's not as big as a position. But what I should be looking at doing is saying basically this week, hey, do I really like this position in Taiwan Semi? Certainly this is a name that we saw a lot of call activity in various different degrees. I don't want that chart. Geez, my computer gets, I guess I have just too many applications open. But the one application that I use to record just takes a ton of memory. So Taiwan Semiconductor, right? So here's a good example. This is a position. I think I have. I don't have my account positions up right now, but I think I have. I had about a 40 lot in this thing. I think I have about an 18 lot left, or a 17 lot in this position. And so again, I've whittled it down from a 40 lot to an 18 lot. I think the chart looks fine, but it may need a little bit more time. If by one day, if we get a big day of volatility and this thing goes from $43 and it goes back down to the 50-day moving average, which is $41, which could definitely happen. I mean, that's not out of the realm of possibilities. I think these are marking at 55 cents. And if this thing happens to go down, the semiconductor, which is a volatile position, if it goes down $1.50, that option premium will go from about 55 cents or 60 cents, wherever it is now, probably down to about 20 or 25 cents. It's almost game over if you get that one day of volatility. So that's what you're dealing with front month. So I urge you to go into your positions and look at how many positions that you have expiring for March. If you're okay with that risk, so be it. But I think that gets lost on a lot of people who are new, or a lot of traders who are new to front month, or excuse me, new to trading, retail traders that are new to trading options. They load up on short-term positions, and because it's cheaper, it is cheaper to go to pay March than it is to go to June or July or August or January, but you're dealing with a lot more risk. So I like to always cover that in the beginning of the month. Because if you've got, I'd say, more than two or three, I don't know why I keep using this, maybe because there's a new movie called Death Wish, but you're just asking for losses. Unless everything goes the right way, then you're going to have a great couple of days. But as we know, things don't go as we want them to go, perfect timing every single time. And if you're asking yourself for that, like if you're thinking that you're going to get another 5% week, you have to ask yourself what the probability of a plus 5% week. Could it happen that we go up 5%? Sure, it could happen. It could also happen that we go the other way too. So you're really putting a lot of, you're really asking a lot for those positions to all work the same way. All right, so I'll ask Bob's question. So if there's any questions about that, but again, I think whatever I have someone new in the room, and not every person who's new, but it just seems like newer retail traders, they tend to load their books with short-term positions. And then, they wonder why, like if there's a little bit of market volatility, like how did I get killed? You got killed because you have short-term positions on, and they're really volatile positions when you're dealing with front month. So you could do something about that now. You have the opportunity, especially before we start to really get into a week before March expiration. But it's a great time to go through, and just like that Taiwan Semi, I may want to just roll the position out a little bit further, just so that it could weather a short-term correction if that were to happen. So day trading options, how far out? Weeklies, 3 months out. I mean, that's something that you need to develop. I wish I could give you the secret formula for that. It's whatever you're comfortable with. I always refer to when you're buying weeklies that you kind of have to be, especially when it's towards the end of the week and you're like, let's say it's Wednesday and you're buying Friday's option expiration. And if the market goes against you very quickly, maybe there's a big sell order that comes in, you could lose 50% of your premium in a blink of an eye. So if you're buying those weekly options to day trade, just because with the way the market is moving, you have to be a little bit comfortable with that type of a drawdown if a sell program comes in. So that's why I really can't answer that question for you. That's how I could tell you how weekly options work. You could also day trade, options that are 2 or 3 months out. I do that sometimes too. It depends on my level of comfort. Thursday and Friday, I could tell you what I was doing. I was taking a shot at Friday. I took a shot at Home Depot options that expire that day. I just thought that the chart looked good, and I said, hey, if this thing pops, if Home Depot goes up a couple bucks and it was trading above value, and certainly it did pop, the options went from 30 cents to $1. I think I hit a target at $1.15. So that's the advantage, is that they're gonna, if they move in your direction very quickly, you're gonna make money. But at the same time, if it doesn't take off like that, if the momentum doesn't come into the name, you might lose that whole 30 seconds in 10, 15 minutes. So I would say if you're starting off, I would not be messing with the weeklies unless you have that understanding and that level of comfort that you could quickly lose 50% of your option premium if there's a sell program comes in and knocks all these names down within 10 minutes, right? So you have to have that level of comfort, and the more that you kind of try these things, I always say when you're starting a new strategy, do it small. So if you want to try trading weeklies, do it with a 1 lot or a 2 lot or a 3 lot until you kind of get the feel for it. Or similar, if you're picking up more, if you are starting more day trading than you ever did before, just keep the size down until you've got a little bit of a comfort level doing that. But certainly there's no need to kind of go in big the first time that you're trying a new strategy. That doesn't really bode well unless you get lucky. Sometimes you get beginner's luck and you're just like, oh, great. Sometimes that beginner's luck when you're trying new strategies can be one of the worst things, because you hit on something, you have a really good trade, and you're like, oh, this is easy. So, and then then the next time you get beaten up worse. So my suggestion is try a couple different things, get your comfort level down, and go from there. Sometimes I will use, so that was my example of what I did on Friday. But, in the beginning of the weeks, you've seen me do this before with like BABA. Sometimes I think BABA has a chance to go for a day, but sometimes I go out to the March option, which I did in the beginning of last week. I day traded BABA using March options, and then I rolled that contract out to June and made it into a swing trade. I took the profits and I rolled them into a trade. I still liked BABA, and that worked really well. I made money on both the day trade and I made it on the swing trade as well, June. And then I took off 90% of that position, that BABA position, and I'm still holding the 10% out in June. So that was is a good way to kind of navigate this market right now, is to maybe keep that small percentage on right now, but make sure that you're taking the profits. And because I'm going to go over the charts and just kind of go through that, but I'll come back to that BABA example. All right, any questions so far? That's a bunch of topics, but again, I think it's just important to know these things before you kind of start to trade or start the new week. So for me, going back to this March's front month, I really won't be taking any positions. I will not be taking any new March positions other than a day trade, or unless I want to just hold something overnight for one day. If I'm playing a catalyst overnight, so I would say right now for me, if I take a March position, it's probably going to have a holding period of less than 2 days. That's just how I think it should be done for my trading, right? I mean, again, this is all not giving you any recommendations or advice. This is all, my experience and what I think works well. All right, so the fear and greed index, I know a lot of people look at this. It's an 18 right now. I think I have this up someplace, but you could bring this up yourself, because I think every time I bring this up, it wants to play a video. But you can see we're still, and a lot of this is the VIX. If you look at the components of the fear and greed index, this is not such a fancy model that they have in place. One of the biggest components of this is the VIX, and it's 50-day moving average. So, yeah, we know the VIX is higher than normal. So, it's got a couple other criteria in here, but it's an 18. So the market is not in any type of euphoric type of atmosphere right now. It's labeled right now extreme fear. I would actually think it would be more towards fear, but it is what it is. Their model says, geez, I don't know why this is happening. Oh, there we go. But it's labeled right now extreme fear. So if you're a little bit of a contrarian, this is probably a little bit better place to buy stocks than it was a month ago when it was at extreme greed. So, starting positions into extreme greed, clearly things can flip around pretty quickly, as they did, and you can get hurt. So I think it's a better environment to be buying in extreme fear. And it's kind of we know that there's been a washout. All right. So what else do we know right now? Everything. So now I'll start going into the charts, but basically, and I want the S&P. I'll start with the S&P chart. But globally, and which is my kind of bread and butter, I like to look at stocks globally. We'll get that out of there. And globally, market trends are still bullish. There really isn't anything that's below, like a major market that's below the 200-day moving average. If you looked at the DAX, and if you look at some of European equities in their local currency, they are under 200 days, under their 200-day moving average. But if you adjust them for dollar adjusted, they're actually all above the 200-day moving average. So, the big thing here, and again, I go back to what I talked about in the beginning of the webinar, where you look at what people are talking about on Twitter, and everybody's like, oh, we could have a retest and fail. We could have, there's really no more certainty from where we were here versus where we were down here. I mean, you have different levels to trade against. That's what you can basically adjust. We know that we bounced on major support, which is the 200-day moving average. We also know that we were sitting below. I use this yellow line on my charts, the 5-period exponential moving average. I use that as a good way just to tell the short-term trend. I mean, that worked really well for all of the month of January. This really didn't tell you to sell at all, because the price for the whole month, or basically almost for the whole month, was sitting, was riding that 5-period exponential moving average up. So there was no break of that at all. Very little indecision with that, and a very easy trend to read. Then obviously the price ducked below the yellow line, but now it's back above. So what I would say is, it kind of got a little bit dicey towards the end of the week with that, with the political headlines. Things kind of stopped in their tracks Friday afternoon, which was a little bit disappointing to trade through. But we had a doji on Friday, and then futures, obviously they opened up yesterday, so we've got another one. So maybe we lost a little bit of that momentum, which again is expected. We had 1, 2, 3, 4, 5 really nice days of market action, and I think you would be kind of fooling yourself a bit if you thought that you were going to have 10 straight days of the big green candles. Do I think that we could get up back up to the 52-week highs? I think it's definitely possible. Could we go back and retest? I think we could also come back in and maybe do like a W pattern as well. That could be in the cards. I really don't have the answers, and nobody does, right? There's nobody who really has the answers about what we're going to do this week. They may think they do, but all you could really do is kind of rely on, what I do is the on the moving averages, or just a level that would tell you how long you're going to watch a trend. So I think now that this has been moving above, what I would say is stay with it, take targets like I talked about in Alibaba. I thought that was a good just a very well played trade, where started the trade initially as a day trade. Made money on the day trade, rolled the profits into a swing trade, took profits for a couple days in the swing trade, and then left a small piece on as a runner, and we'll see what we do. Because I mean, my guess is that maybe we could chop a little bit here. I don't know if my gut tells me that I don't believe that we're going to go all the way back down to the 200, but maybe we duck under. But that's just what my thoughts are. For now, I would say we've got overhead resistance of the bottom of value, and we're still tracking above the yellow line. So I would say if price action ducks below this yellow line, which will also coincide with the 50-day moving average, that's a nice little signal to take, maybe trim your profits or have a bigger position of cash until this thing kind of works its way out, or just manage your positions a little bit differently. Gartman has the answers. But the other thing is just watch your duration in your option positions. If you think that we might stall here a little bit and we might move down, if you want to take new positions this week, just scale into them a little bit and realize that you might be able to get into them at lower prices. So that's kind of where I'm thinking, and also the positions that I really like. If I happen to see March options go up, as long as it's a liquid option. I mean, this is the other thing that I think a lot of traders that follow option activity, they think that they have to jump in the exact same strike or the exact same maturity. And I talk about this a lot in the room, but as long as unless the bid-ask spread is really, really wide, and if it's a name that we don't see a lot of traffic in, if it's something like Disney, right? We saw Disney calls last week. You could go and you could pick any Disney option. It's the bid-ask might be a little bit wider in different months, but that's a name, or Microsoft. Some of these names that we've been seeing call activity in, Micron. You could pick whatever your comfort level is. You don't have to go after if it's weeklies that we see on the tape, if it's February 23rd, if it's March, or you could also just trade the stock too. I would say don't be afraid to trade stock here. And I don't know what, and that's another thing that, I think also gets lost on retail investors who've become very active trading options. You've got in your arsenal, you could do whatever you want. If you feel a little bit more uncertain about the short-term conditions, put the stock on. The stock is not going to decay, especially if it's Amazon and if it's Google. Yeah, it's going to be tough to put those on in stock. But if it's something like, I put out a couple examples this week. What was the one? Like this RKW. Like if you like this thing, it's a $50 stock. I mean, but I will probably be putting this on in cash. I think that's, it's a position that I would want to hold on to for a while. And, I don't really want to mess with, or FDN, which I think I put that one on as cash as well. But this one's a little bit, it's $50. But I think anything under $30, you're kind of taking all of those things, the higher implied volatility that's in the options, right? That implied volatility is a component of Black-Scholes, which goes into the option pricing model. That is one of the things. So options are a bit more expensive than they were a month ago, right? So that goes back to what do we know? So don't be afraid. I think I used Scott as an example, I think last week, but when the volatility I think was above 30, Scott is more of a day trader as far as I know, unless he's doing other stuff, which I know he does have a long-term account, but for his trading he's doing a lot of day trading. But he was just day trading stock and changing around his strategy because the implied volatility was a bit too high. So there's a lot of different things that you can do. For me, where's this little PowerPoint presentation? I hate PowerPoint. But for me, it's going to be holding a little bit further at dated positions, and it's just going to be scaling into positions a bit, but just being a tad bit more aggressive, a tad bit more conservative. Unless it's a name that really has a great setup. To go into just to kind of turn the subject a little bit. Sector winners last week. If you could see with the overall market, I think the S&P was up around 5% last week. But look at some of the sector winners. I mean, these are just straight sector ETFs. These aren't even single names. So there was a lot of movement in names, and I think we're going to continue to kind of have that. Maybe not up 10, 11%. But look at the different groups that were above 5% last week. I mean, these weren't even similar groups. You had steel names. You had Chinese internet names up 10%. You had defense names, defense and aerospace names up 6%. You had U.S. internet names, your Amazon, your Google. Those names really did pretty well last night. Then even like the banks were up 5%. International was also very strong last week. So my point is, with looking at this, going back to the S&P and going back to this particular ETF, I also think just looking at individual names. Now, I did mention implied correlations have moved up a little bit, but I don't think it's game over for stock picking. I do think that you have the availability to trade the indices more now that implied correlations have perked up. But, the one thing that I noticed was, as I analyzed the inflows and outflows in ETFs, I mean, you go back a week ago and what was there, $23 billion of outflows in SPY. So most of the unwinding that happened because of that volatility trade where people got caught, a lot of the unwinding happened, it was in SPY. So if something like that happens, a big seller comes in and they dump a whole bunch of SPY, you have to realize all those names, those 500 names that are in SPY, they're kind of going to get hit with it. Now, that's not the only market force, but you kind of one of the things that I noticed was names outside of the S&P 500, they fared a little bit better. So names that were a little bit under coverage fared pretty well. What's the one name? Goose. I mean, Goose is not in any major index, right? So if they're going to sell, and if they're going to, some of these big indexers or guys who have this model, CTAs, if they're going to have this big model and they're going to sell S&P, I mean, it almost would be better to be involved have a couple small cap names. Some of these small cap names barely went down at all. I think Goose actually went down a little bit on earnings, but like I was looking at this name too, this Coupa Software. If I can get this to come up on Thinkorswim, but there was a lot of names that really did not get as beaten up as your S&P 500 names. I mean, look at this name. There's no weakness in this name. So I think having a variety of positions in some different groups and different sectors will also help you a bit. Rather than have, 5 of the same, having Google, Amazon, Apple, Facebook. If you have all your eggs into that basket, and there's a big, tech stocks get hit, and there's big outflows in the queues. There's money being taken out of that group. You're gonna, suffer at that market reaction, right? So. I think having positions in a couple different groups may help a little bit. I mean, if we do get a market pullback like we had a couple weeks ago, odds are the majority of your positions are going to get hit a bit. But I think having a few names in just completely different areas may help you to weather the storm a little bit. So being more diversified is the point that I'm trying to make. Might help you survive if we do get another of a move down. So why am I talking about that so much? Another move down. Well, I mean, on Friday there was a lot of index puts that went up, and I could either ignore it and say, oh, they're going to be wrong, or I could just try to be a little bit prepared for that. I mean, look at all the SPY options that went up, and it's mostly short-term stuff. I mean, there was one SPY order that was in April. But most of the aggressive, and again, we sat and we watched Friday afternoon, and also there was a lot of VXX call buying. So somebody's apparently looking for volatility to kind of hang around for a little while. So I hope that they're all wrong, and a lot of times they are. When they're buying, when the market starts going down and reacting to something on the tape, and they start buying protection and a whole bunch of stuff. I talk about this a lot, but I refer to that as kind of the dumb money. These guys are they're not prepared, and they think that there's a headline that just hit and the market looks particularly weak at this moment. They're not really doing much analysis. They're just making a spur of the moment and saying, hey, I need to have more protection on. And I think that's what happened Friday afternoon. And again, look at the majority of the transactions that went up. March 9th, March 2nd. February 23rd of these put trades, Qs for this week. So, if it's one or two index big put options, like we've been seeing all of 2017, that's like, oh, they're doing a little bit more hedging. But when somebody comes and buys over and over and over and over SPY puts or IWM puts or Qs puts, I tend to take a little bit more notice and not just completely ignore it as dumb money. Like if they're really putting a lot of money behind it, maybe I want to just err on the side of being a little bit more conservative in the short term. And again, that I went through, there's many ways to do that. There's not buying front month. There's buying, if you're going to stay in the option game, most of my positions that I've been adding. Again, I could relay what I'm doing. I think I have one March position right now open. The majority of my positions are further out. I think I've got 1 or 2 April positions too. but I've got a lot of June and new trades that I'm looking for. I want to go further out, at least until the VIX comes in a little bit further, maybe down to 15. Then, if I want to take a little bit more short-term, you know, positions, but I really think that it is what it is. There's higher risk when you have these short-term positions on. So I'm more comfortable paying a little bit more in premium. So it's kind of a cut between having that short-term option position on versus having stock on. It's kind of a little bit more middle of the road. Remember, why do you want option positions on in the first place? They're nice. They can provide leverage. They're also an easier way to get exposure to a really high-priced stock like Amazon. All right, so that's kind of my strategy for this week. It's going to be reading the tape again. We'll see if we had a couple days last week where the option activity was pretty abundant. We also had a couple days where it was kind of quiet. I mean, we don't need to see 50 aggressive trades on the tape, but it just kind of gives you a sense if people are out there really, they're spending, right? Funds are spending and they're finding opportunities in the market. So it really gives you a sense once we start to see, some of the bigger orders go up on the tape, some of the blockier orders, and a higher frequency of the aggressive stuff. That guys and girl traders, institutional traders are not so much worried about that volatility. They're actually putting more money to work. And that should give you a little bit of a comfort level that they're out there and they're buying stuff up, right? So it really gives it a nice sentiment indicator. If there's no orders on the tape, if they're not buying anything, and we see a lot more protection, then you have a sense that people are a little bit worried about the short term, and they're not putting new money to work. So will be a great indicator to watch. I think on Friday was a combination of things. I try not to read too much into the price action before a 3-day weekend. I think generally a 3-day weekend, the risk taking decreases and the VIX does go up a little bit. Friday was a little bit different because that political headline came out about Russia. So that was more extreme than what we normally see ahead of a 3-day weekend. So, but yeah, I mean, I would say most of the protection that was bought on Friday was very short dated. So if you have a longer time frame, things may play out and that might be okay. So I'll go on to a couple other subjects, and then I can go through this weekend's newsletter as well. Any topics or any questions that you guys have so far? But I think we've been through about 50 minutes, so that's a lot. And again, these are all topics that I think are just good to go over, just game plan, because I think so many times we get into, we're creatures of habits. We're a creature of habit. So trying to kind of change around what you're doing to adapt to the market conditions, you really have to be aware that you're trying to change your style, your trading style, rather than just doing the same thing over and over, and adapting to different market conditions. Because it is what it is. The market conditions has certainly changed from where they were a month or 2 months ago. So another thing that we know, last on my list to really talk about for what do we know, is inflation has ticked up, and bond yields have gone up too. So there's different stocks too that, I went through and I talked about in this weekend's. Actually, I didn't put in the newsletter. I'm going to talk about the new channel that I set up in Slack as well. This is called Swing Trade Setups. There we go. Swing trade setups. So this will kind of give me just a channel just to post where you could basically come in if you're, if you can't trade all hours of the day and you want to know what I'm looking at. I'm going to be posting a lot more option setups. Like, so for example, I just threw Western Digital in here. I know we talked about Western Digital quite a bit on Friday, but I'm going to be doing this during the daytime where, hey, we've got a big order that came up. This way, if you're not in the room, the 6.5 hours that the market is open every day, you could quickly come in and you could say, hey, what were the big trades of the day? So I plan on kind of putting this analysis. Western Digital, which I started a position on Friday, I did not, I told myself going into the day on Friday that I really didn't want to add any new positions. But, there's ways, like I mentioned, that you can kind of trick yourself a little bit. So even if you see a really nice trade on the tape, now granted this was a July trade, so your odds are you're probably going to have plenty of opportunity to get into this position because again they went out to July. You could also see that I don't really love the setup here. This is the downward trend line on Western Digital, and you could see that it's had some issues with getting above this downward trend line. It's also still below the 200-day moving average. So, even though I think I put on a 2 or 3 lot, that's not a chunky position. Basically starting a position with $500 or something like that. So on it, as soon as we see the option activity, now I can kind of wait and watch this thing, see if it at least gets over the 200-day moving average. Really, I talked about this 95 level. There's a VPOC up there. That would make that into a profitable trade. But some of these things you could also just keep as small positions. And that's another way to kind of do it too, is just reduce your position size too. So again, there's all these different things that you can still be in the market and participate, but you could go out further to avoid that short-term volatility where you don't get, your ass handed to you if it does happen. It's a very technical term, by the way. Or you could just take smaller positions. And sometimes a lot of the smaller positions that I take end up being huge winners. Because I just feel more like you feel comfortable. You're like, I'll let this thing go as long as the trend goes. You're like, holy shit! When I got into this trade for a couple $100, it's now worth $2,000 because you just followed the trend, and you weren't antsy to take the position off. So, that happens a lot for me in some of the positions that I just decide to hold because they haven't broken any support, and that's what it's all about, really, too. Is to let some of these names play out as long as they don't break support. So what else? So some ideas for next week. So this is the again, it's called swing trade setups. You can see I've got a nice name for inflation. This is a name that so I'll start getting into charts unless you guys have any other questions. How do you get Slack? Did you just signed up? Tap 98. Everybody who's recently signed up. Okay, I'll have to give you permission for it. My assistant is not in right now, clearly, but last Friday, If you wouldn't mind, you could private message me in here. Just send me your email address. Because I should, most likely, if you've already probably have gotten a invite for Slack, sometimes these things go to your junk folder, but our process is usually pretty good. As soon as you sign up, you should be getting an email from Slack with an invite. So REMX. So this was a position. If you go back to the cash trend portfolio that I have. By the way, does anybody have any? Again, this is a great time to ask questions. This is a portfolio that I've been running since March of last year. It's been doing very well. If anybody has any questions about this portfolio, please let me know. But it's just cash positions. So this is a great portfolio for, people who can't be in the room for all times, and if you're also managing some longer term positions. But what happens is it's a systematic portfolio. It's a systematic portfolio, and I've got my stop prices built in, so they're not hard stops. So first of all the stop prices that I use are soft stops. They basically give me an alert. In this sense, when anything says if something is breaking, so every time I get into a trade, so for example, MCHI, FDN, and EEM were 3 trades that I put on last week. Those are all being established. I think the one is using the 50-day moving average. The other ones are using the 100-day moving average. So if they come up and the price breaks, and it's 1.5 ATR, which is average true range, which is a little bit kind of sets a volatility assumption for these trades, for how much position size I take, and also to kind of help me with a price a little bit below the moving average so I don't get whipsawed. But so if the price gets below that moving average, that's it. I'm out. I don't really make any judgment calls. So hence the systematic approach. But I took a bunch of these positions off when we really got that when we got the 10% correction in stocks. I took off. One of the names was REMX, and I think I took this off. I'm going from memory, but I think it was the 50-day moving average in REMX that it broke. So if it retakes it, so here's where I got stopped, but it's starting to reclaim that 50-day moving average, and I want to get back into that trade. I think this is a great way to play higher inflation. So REMX is a name that I'll be looking at in cash to get back in. And then other positions, what I've started to do as well, I started this program, I think just the timing was a little bit bad, starting the limited risk reversal program, which is basically the same thing. I want it to be a systematic trend following trade. So I'm going to be doing more of those trades, and I actually set up, like in the position sheet that I send out every day. So there'll be more to come on this. I'm still tinkering with it a little bit, the process, but I've actually set those positions up with stop prices as well. So there'll be a lot more monitoring with some of those trades. So I've got 4 of those trades on. There's a couple of them that are kind of broken. The OIH is broken. The DAL is also not working. Same thing with SLCA. The only one that's really working is the square trade. But the nice thing about the limited risk reversal, and I'll get into this the next time I put on one of these trades, is you're defining your risk. So it's usually $500 per lot is the most risk. So it kind of has a self-stop, being that that's the most that you could lose. The whole idea with trading is to have small losers and big winners. So, maybe keeping that lot size very small, meaning that's the only thing that you could lose if you're doing a one lot is $500. But I will be doing more of those trades and further out trades. I've already looked at a couple of them that I want to put on for next week, right? So part of this, going through what I like to go through and going through the technicals, you could see a couple names. So I like LVS a lot. And I like the PEJ ETF a lot. Because I think the consumer is still spending. Things like tax breaks are usually pretty good for the consumer, and I think the consumer will be spending for a while. So, this PEJ just like a lot of other stocks. So this one doesn't have options, so this one will be a cash position. But like a lot of other stocks, it found support. This one's in value, so it looks a little bit stronger to me than the S&P. But maybe I'm probably going to wait for an MACD crossover for some confirmation. And even if it gets above the 50-day, the value area as well, that might be a little bit of confirmation for me as well. And then what I like to do often is, PEJ is if you're not familiar with that ETF, is Dynamic Leisure and Entertainment. Then I like to go through the holdings of the ETF and kind of go through the charts one by one to see what chart setups really look nice. And what I noticed is the largest weight in the PEJ ETF is Las Vegas Sands. I mean, look at how nice this chart looks. Talk about relative strength. First of all, it only broke the 50-day moving average, and it did that 1 or 2 days, and it's been right back above. It's above all the short-term moving average. So it's regained all the short-term moving averages. It's in value, which is a lot to be said considering a lot of stocks are trading right now below value, like the overall indices are. And for Las Vegas Sands, I would wait for, if you want more confirmation, wait for an MACD crossover. But yeah, so I'm looking at a trade probably out in September for Las Vegas Sands, and it will probably be a call spread, which is again another way that you can cheat a little bit with the implied volatility by putting things into call spreads. You're also using that volatility by selling an out of the money call spread further out. So that's what I'm looking for Las Vegas Sands. What I'm actually looking to structure this as a limited risk reversal, where I'm selling a put spread, taking those proceeds and buying a call. So that's what I'm looking at for Las Vegas Sands for this week. And again, it's good to have a whole, a few names at least on your watch list. And I like finding the nice setups before we see the aggressive call activity, because then you're kind of ready. You know the setup. You don't have to go kind of researching at that point. And I think that's a lot different than what a lot of people who use aggressive option activity. They only get into a position when they see option activity. So I like getting into positions sometimes, and then the option, people are looking at the same setups. Like this is not rocket science. It looks like a great looking setup. So, so maybe we see call activity in this one this week. Who knows? But it's really nice to be in a position and then see the option activity. And then to get the momentum from that. I mean, that is just lovely when that happens. All right, so that's a name on my watch list. And then, I put together a couple other names. In that sector, I think all of the cruise lines look pretty similar. And what's nice as well, another positive that you could look at is a lot of names have already reported earnings, right? I hate trading names. I hate having to deal with names that we see option activity in, and we're still seeing that. We saw a bunch of names last week where there was some aggressive option activity in the name reports this week. So, if you're okay for a trade for a couple days, then that might suit you. For me, I usually want to hold longer than that, so it's not the best setup for me. Plus, you don't know exactly why they're buying those options with that earnings event. But a lot of names, like all the cruise lines, all the airlines, Las Vegas Sands, all these names reported earnings, so you don't have to worry about really structuring a trade to kind of avoid that. All right, so that's basically, I can continue to go through a couple other things, but I'm happy to go through any questions that you guys have. But really, what I think is also important, I did have one other slide, but you could see we're already past an hour, and I don't want to keep you guys that late. I already talked about this. Be careful of the short term. I think I already mentioned cash as a position. Really this one is what I talk about a lot, but setting alerts and honoring stops. That helped me a lot in the last bout of volatility. That really kind of saved me in some positions to get out at like the 50-day moving average, and not have a big loss on my hands. Realizing that you could get right back into the position if need be. I know it's tough. the psychology that goes on with a lot of traders, including myself, is when you sell, you kind of have to admit that you're wrong. Uh, and number two, you have that fear of missing out. That, hey, if you sell, oh my God, it's going to rip higher. But this type of trading where you're setting the alerts and you're honoring your stops, you're selling, it comes with experience that you kind of realize it's the right thing to do, and you have faith that you can monitor the position or the particular stock that you got out of to get right back into it. So it kind of comes with some trading experience that you could sell. Again, having those small losers, but you are going to have to admit that you're going to have to get out of something that you thought was a great idea. So there's a little bit of a mental battle that has to go on there. But I'll tell you, sometimes once you sell those positions, it's been like a weight has been lifted from you, and you're like, hey, I'm in cash now, and now I could objectively look at where the market's going to go. So it has helped me a lot to kind of put this portfolio together and use alerts. Again, having these trading alerts in whatever system that you are using is a godsend. To have an alert to tell you, hey, something is breaking. Again, you actually have to set the alert, which I will say it's smart to do as soon as you get into a position, right? Of course, you're thinking about. You could be thinking about how much money am I going to make in this position, which again, an experienced trader will always look at, okay, I got into this trade, how much could I actually lose if it goes against me? So one of the first things that you should be doing as soon as you get into a position, I know what I do is I set an alert to make sure that if the stock was higher, I'm taking some off the table at the right price. But you should also be, once you probably put that target out there, also be putting an alert. So right now, we look at any stock, but let's look at, I've got the S&P up. If I was long the S&P or SPY, I would be setting an alert probably right here. 2710. If I was long a swing trade, just as long as, and again, it doesn't matter. I talk a lot about, what indicators like people use, and it really doesn't, whatever works for you. I have mine very simple that works for me, but some people use the Ichimoku cloud. It doesn't really matter whether you use the Ichimoku cloud, moving averages, as long as you could foot to a price that is going to tell you to get out of a position when it's not working, or gives you an entry signal. But really it's price. Price is the biggest thing to watch. You could do your second tier analysis with the moving averages and whatever, the cloud or MACD or RS, whatever indicator you could use, or some proprietary indicator that someone comes up with. As long as you're using it and honoring the stops, that's what trading is all about. It's not about finding the perfect indicator. It's just being disciplined and following your trading system. So that's really, I think, what it's about. And I think, again, a lot of new traders, they're looking for the holy grail of indicators, and there isn't one. If there was a holy grail of indicator, everybody would be using it and making money. So it just doesn't work. I hate to break it to you, but there is no magic indicator that is going to make you money. It's you who is going to make you money, and your trading system and your discipline. So again, I'm not going to pretend where I know the S&P is going. It looks like it's digesting a little bit. It looks to me like it's kind of at a decision point. It needs to, my opinion, get through value, or it's going to fail a little bit and go below, or it could just chop before it actually makes that next move. So let's say we chop for like a whole, all the way till March, then I would say this line is probably going to be your support. But, there's different trades for different outcomes. For now, I don't want to read too much into it, other than, we have a doji on Friday. Since futures have opened last night, they've been a little bit weak, other than the initial move, which was higher. And I would probably look to take more action or more management in my positions if we start to turn down lower. If we just do this and we chop back and forth, then there's really not much for me to do with the current positions that I have on. I hope that I have enough time in my positions for it to kind of weather a choppy market. If we go up, that would obviously be the best predicament because I'm positioned long. But if we start to break the 50, the 20, and the 5, I think there's some action to be done for how you're managing your positions. I will be, at least. I'll be dumping a couple positions. And I think, so I did that on Friday too, and I put out a quick video about that. Like Caterpillar. So why did I take that position off in Caterpillar? And I'll wait for Thinkorswim to bring this up. But I took off 2 positions on Friday. One was MGM, which was a swing trade, and I didn't want to hold a swing trade into earnings. And I think they report tomorrow morning, as well as Home Depot. But here's a good example, and I may have been a little bit early with Caterpillar, but I really wanted to take off a little bit of risk going into a 3-day weekend, and I could be completely wrong here. Caterpillar ends up moving up. Perhaps I could get back into it, but it broke the 50-day moving average. It didn't. It actually did not break the yellow line, which is the 5 period. So maybe I'm a little bit early getting out of this, but it closed below the 50-day moving average, and this was a position I put on someplace in here. I forget which day, and had a small winner of a trade. I think I actually took the final piece off for about a scratch. But I took one target for a winner. But hey, I'm respecting price. And if it starts to go below, if things start to head back below the 50-day moving average, I don't want to sit. I don't want to sit in them. I want to sit in stuff that's going up, not that's starting to turn back the other way. To who knows where it's going to go. Right? But that's an easy way. I mean, especially since a lot of names, and again, we have to go through names one by one to kind of see this. Maybe I'll bring up Amazon. But I don't want to be, if I've been in long positions and they start to break the 50-day moving average, I don't want to be in that. Right? Why would I want to be in positions that are starting to go below the 50-day moving average? Amazon is obviously much stronger than that. The 50 days all the way down here. 50-day we just barely touched. But maybe for Amazon, if it breaks the 20, unless I'm in like a January position, right? But if I'm in something that's like, I think the swing trade for Caterpillar was maybe April, I want to say. So that's a perfect example. Like if I was in an April position in Amazon and it breaks that 20-day moving average, that blue line, I don't want to be in that stuff for now, until it kind of shows itself that it's back doing good things. Right? All right, so that's all I have for tonight. So we'll cover about an hour and 20 minutes. Thank you for joining me. If you guys want to go over if you guys have any other questions, or if you guys want to go over any charts, I'm happy to do that. Yeah, I mean, definitely. Let's just give me 1 second. I just want to see. Okay, 1 second. Show the PEJ chart again. Sure, absolutely. Steel stocks moving. Yeah, so the steel stocks they all took off. There was a lot of grab for some of these names, and then I'll go back. Don't worry, I'll go back to PEJ. Let me just get rid of this, and I'm gonna shut off the recording now as well too.